Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar has shown weakness, stock indices have regained their safety cushion, gold is caught in a tug of war, and Bitcoin has hope that there will be no crypto winter. As soon as the US dollar weakened, its competitors immediately stiffened their resolve. The pound rose on a new UK budget, the yen on government intervention, the Aussie dollar on rate hike talk, and the euro on hopes for peace in Ukraine. However, the foundation for the decline was laid by the dollar itself. Dovish rhetoric from influential Fed officials, a series of disappointing economic data, and the Hassett factor triggered a sell-off of the dollar. New York Fed President John Williams, San Francisco Fed President Mary Daly, and their FOMC colleague Christopher Waller are inclined to cut the federal funds rate in December. In their view, the risks of a cooling labor market outweigh the risks of accelerating inflation. Data support this view. ADP reports a decline in private sector employment, while another report on repeat applications for unemployment benefits has returned to a 4-year high. Concerns about the fate of the labor market are forcing Americans to tighten their belts. As a result, the chances of the Fed cutting rates in December jumped to 85%, triggering a fall in the dollar. U.S. stock indices are rising, with the Nasdaq Composite recording its best 4-day rally before Thanksgiving since 2008, driven by renewed confidence in further easing by the Federal Reserve. Speculation on this has allowed investors to overlook the inflated fundamental valuations of tech giants and questions about profitability. According to Reuters, market mania has caused the weight of tech giants in the S&P 500 to rise from 30% to 31.1% this year, while their share of profits has fallen from 22.8% to 20.8% due to colossal investments. As OpenAI aptly noted, you can overinvest and lose money or underinvest and lose income. Investors are breathlessly watching the duel between two giants, Nvidia and Alphabet. The latter's shares are rising much faster on rumors that Meta Platforms intends to invest billions of dollars in Google's AI chips. Gold is in a tug of war. Its price is being driven up by growing expectations of policy easing, which are weighing on U.S. government bond yields. On the other hand, active work on a peace plan for Ukraine is acting as sand under the wheels of the gold rally. In the 3 years since the global gold rally began in November 2022, the price has risen by 170%, driven by frenzied demand from emerging market central banks for physical gold, at the expense of the U.S. dollar. Thanks to this, the precious metal has risen despite aggressive policy tightening by global central banks. A peace agreement between Moscow and Kyiv could remove the political risk premium, neutralizing a critical catalyst for growth. However, gold bulls have something to respond with. Rumors of Kevin Hassett's appointment as Fed chair have allowed the futures market to lower its implied terminal rate to 2.75%. At one or more FOMC meetings, borrowing costs could fall by 50 basis points. As a result, the US dollar and Treasury yields are expected to fall. This creates a tailwind for gold, allowing UBS to forecast a rally to $4,500 by the end of 2026. Deutsche Bank sees an average price of $4,450 per ounce. A diverse investor base, growing use of hedging, and a larger market are allowing Bitcoin to break the rules of the game. Unlike previous episodes of Bitcoin declines, this time, a surge in volatility does not accompany the price collapse. This is a healthy correction in a mature market. At the same time, the potential for a rebound appears limited compared to previous cases. During the previous crypto winter, Bitcoin experienced a decline throughout the year and then spent about 15 months recovering its historical highs. That story may not repeat itself, despite the loss of $1 trillion in capitalization. The rapid growth of U.S. stock indices has improved risk appetite, allowing Bitcoin to find a bottom. November risks becoming the worst month for Bitcoin since 2022, with a record $3.6 billion capital outflow from ETFs. However, rays of light are beginning to break through the clouds. The first week of December may evoke a sense of deja vu. Speeches by Fed Chair Jerome Powell and FOMC member Michelle Bowman are likely to be dovish. Data on business activity from the ISM and private sector employment from ADP for November will continue to signal a cooling of the labor market and the U.S. economy as a whole. Donald Trump and his team will not stop putting pressure on the Fed. The further upside here is insignificant. as the chances of a 25 basis point rate cut are now at 85%, indicating the confidence of participants in the futures market. A return to a more hawkish policy in the coming quarters could support the dollar. Russia's maximalist plans for Ukraine could also help the dollar. Peace talks have reached an impasse so many times already. If Moscow takes a step back this time, the euro will feel the pinch, as current euro-USD quotes are partly based on expectations of an end to the armed conflict and a reduction in geopolitical tensions. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.